Good morning. You're watching a live market outlook for Tuesday, 15th of November 2011, prepared by Windsor Brokers. The main focus remains on Italy as increased fears of the possible worst scenario keep the pressure on the markets, with the US dollar now acting as the main safe haven instrument. So the gold is lower, following the losses in the riskier assets and the increased worries about the Eurozone ability to contain its debt crisis. The Prime Minister of Italy, Prime Minister designate Mario Monti meets the leaders of Italy's biggest two parties today to discuss the many sacrifices needed to reverse the collapse in market confidence that is driving and even deepening Eurozone debt crisis. As I mentioned yesterday in yesterday's session, that the Italian debt is too high, that cannot be bailed out by European Central Bank. The global equity markets and the euro were under pressure and slid yesterday, and extended actually losses during the Asian session on doubts that Monti and Greece's new leader Papadimos would take the enough steps needed, and the report said the situation in a AAA rated Eurozone power France should be ringing Eurozone alarm bells. Greece's new technocrat Prime Minister Lucas Papadimos said on Monday that Greece had no choice but to remain inside the Eurozone, telling lawmakers reforms were the only way to mitigate painful austerity measures which had deepened the recession. But conservatives, on whom he must rely to support, demanded pro-growth policies and rejected talk of further austerity measures, fueling fears of Greek default that might force Athens out of the 17-nation euro currency group and trigger a Eurozone debt meltdown. All this, actually, another comments from German Chancellor Angela Merkel, who caught the mood of crisis with a stark warning on Monday that Europe could be living through its toughest hours since World War II. She told her CDU party she feared Europe would fail if Europe failed, and vowed to do anything to stop this from happening. The Italian new Prime Minister Monti will pursue his efforts today to secure enough support from Italy's politicians to allow his cabinet of experts to speed up delivery of extremely painful reforms of pensions, labor markets and business regulations needed to put Italy finances on a sustainable footing. Italy has to refinance some 200 billion euros of bonds by the end of April, a daunting prospect given it was forced yesterday to pay a euro lifetime record yield of 6.3% to sell 5-year bonds to worry investors. The auction and the release of figures showing industrial production slumped by 2% in the Eurozone in September, and this raised the specter of recession and provided a gloomy backdrop to Monti's consultations with the heads of smaller parties. So as we can see, the outlook for the whole Eurozone is getting more and more covered by dark clouds, and the further steps of the Eurozone officials actually will give us some more clues whether we are going to have the worst scenario, the meltdown of the Eurozone as a union, or there will be a way to escape from this. From the other side, actually the recent results and the current situation shows that the world's major economies, none of the world major economies will escape a slowdown. The Organization of Economic Cooperation and Development said yesterday, highlighting increasing signs that growth momentum is dwindling across the board. The Paris-based organization's composite leading indicator called the CLI for its members fell for the 7th straight month to 100.4 in September, down from 100.9 in August, and hinting the lowest reading since December 2009. Readings for individual countries and the big developing world economies were broadly lower at levels indicating slowdowns and were in many cases below their long-term averages. The OECD CLI index are designed to anticipate turning points in economy activity related to turnaround in the indicator tends to precede the turning points in economic activity by around 6 months. The group of 7 CLI fell to 100.6 in September from 101.1 in August, while the reading for the Euro area dropped to 99.1 from 99.9, well below its long-term average of 100. Japanese CLI remained above its long-term average of 100 with a reading of 101.6, but it was still down from 102, suggesting an economic recovery after its March earthquake and tsunami disaster is losing steam. Economic momentum in the United States eased only slightly according to the OECD indicator, which fell to 101.2 from 101.5. The Chinese economy also showed the only marginally weaker activity with a reading of 99.8, down from 99.9. Among other emerging market economies, Brazil's CLI fell to 94.0 from 95.1, while India's reading decreased to 93.8 from 94.4. As we can see, all these indicators are signaling a slowdown of the whole world economies and giving us more dark outlook for the near future. As mentioned earlier, the euro was again lower after losing its strong supports at 136.55 and 136.00, as this morning fresh low was posted at 135.75. The euro dipped overnight and it's stuck near the bottom of its recent trading range after a rise in Italian and Spanish bond yields underscore the challenges facing European leaders as they struggle to contain the region debt crisis. The cable also is lower and currently testing the recent range lows, below which would be risky and might signal further reversal and confirm the near-term top. Currently the pair is in the light corrective trading mode. However, the upside remains quite limited. More we'll have in the our technical part. Now let's take a look on today's calendar, which is quite rich. Already released the German preliminary quarterly GDP that came along with expectations at 0.5% compared to the previous quarter at 0.3%, and still to come at 9:30 GMT the UK's yearly CPI that is expected slightly to decrease. Today's forecast is 5.1% compared to the previous release at 5.2%. While core CPI on yearly basis in UK expected also to stay unchanged at 3.3%, which is today's forecast, compared to the previous release at 3.3%. German economic zoo sentiment due at 10 o'clock GMT is forecasted to drop significantly. Today's consensus shows the figure of -51.8 compared to the previous month release at -48.3. With at the same time, Eurozone actually quarterly flash GDP is expected to stay unchanged at 0.2%. European zoo economic sentiment due at the same time at 10 GMT is expected to decrease to -52.7, which is today's forecast, compared to -51.2 the previous release. And the Eurozone trade balance at the same time is expected to narrow by 0.8 billion euros versus 1 billion euros gap of the previous month release. From America's manufacturing sales from Canada due at 1330, expected to grow this month at 1.1% compared to 1.4% the previous month. And new motor vehicle sales on monthly basis from Canada are expected to grow by 1.9% versus the previous month release of negative 0.4%. Core retail sales from US at the same time monthly expected to decrease by 0.2% compared to previous release at 0.6%, while monthly PPI from US is expected to decrease by 0.1% compared to 0.8% of previous month release. US core PPI monthly is forecasted 0.1% versus 0.2% previous month release, and Empire State Empire State Manufacturing Index from US today's forecast is -2 compared to -8.5 the previous month release. Later in the afternoon, US business inventories monthly are forecasted to grow by 0.2% compared to the previous month growth of 0.5%. That would be from today's calendar. Now we're going to take a look in our charts and see the latest movements and the expectations for the coming day. As we can see, euro is in the sharp fall from yesterday's high at 138.10, losing initial supports at 136.55 and 136.00. There was a brief break last night to 135.90, and then mild recovery up to 136.25, followed with today's fresh push lower, dipping down to 135.74, which is day's low until now. Some corrective action is seen on the oversold hourly conditions, currently testing immediate barrier at 136.20, which is hourly 20 days moving average, ahead of 136.42, which is the overnight high of this corrective consolidative range. However, break above 136.50, 55, which is the previous support, now reverted to resistance, is not expected to give some significant results, with 136.80, 137 zone expected to cap the corrective action for now. I would say the main barrier at this point stands at 138 and 138.50, which is also 50% Fibonacci retracement of the broader down move from 142.46 to 134.83, and only break here would give some results and bring some more positive tone in the current weak structure of the euro dollar. On the downside, 135.74, today's low, is the initial support ahead of 135.50, psychological support at 135, and the key near-term level at 134.83, below which would be bearish, and look for the levels at 134, 133.70, which is the next target zone in case of loss of 134.83. The British pound is in the near-term recovery mode after a sharp fall followed last Friday's strong rally that was capped just under 161 barrier, and ahead of key resistance at 161.64, and on the daily chart, the 200 days moving average currently at 161.35. Sharp losses fully retraced the recent rally, and tested the previous low at 158.67, which is the floor of the recent range that the pair continues to move in. Currently, the corrective action is seen limited initially at 159.50, which is 20 days moving average, and the previous high at 10th of November at 159.84, below which would maintain this near-term negative tone. A loss of 158.67 low, as the pair registered the fresh one at 158.71 during the early hours of today, would signal further weakness ahead, and open the next levels. 158.50 is the mid-October's consolidative range ceiling, and then 158.25, the Fibonacci 38.2% retracement of 152.71 to 161.64 a cent. Loss of these levels would confirm the temporary top at 161.64 and open way for a further extension lower, as 157.50 and 157.15 comes next. The first one is the low of 21st of October, and then we have 50% everything. So on the short term, the most significant support is now under pressure at 158.67, below which will weaken the current structure. Holding above here, the signal the pair still moving within the recent range that is capped upside at 161 initially, and then 161.5, 161.64. Clearance of these barriers is required to the latest rally from 152.71. Dollar yen had some unsuccessful attempt higher during the night. Actually, it was mistaken for the intervention. There was a big number of buying orders that briefly pushed the market. As you can see, the market spiked to 77.50 high during the Asian session, and the investors thought at the beginning that this might have been intervention of the Bank of Japan. However, it proved that it was just a number of big orders, as the pair quickly returned back to the 77 zone where it's currently moving. The near-term outlook remains in the negative field, as the MACD holds below the center line and currently breaking below the signal line, suggesting further losses ahead. Momentum is also below the center line, with 20 days moving average currently at 77.04, offering initial barrier. A loss of yesterday's low at 76.80 to open way for further extension, and 76.50, 76.00 to come next. On the upside now, 77.50 is our main barrier. It's a high of overnight and the low of 10th of November, and the only break here would bring some positive tone in the current structure, and possibly open way for test of key barrier at 78.00. For now, the near-term outlook maintains a negative tone, and the 76.80 yesterday's low remains in focus as long as 77.50 caps the upside. The dollar Swiss is in a strong up move after clearing the previous low highs and the strong resistance zone at 90.80 and the psychological barrier at 91.00, extending again so far to 91.38, just ahead of 91.47 high of 10th of November. That is currently in focus. Hourly studies maintain the positive tone. As we can see, the MACD is breaking above the signal line. However, overbought conditions on the hourly chart suggest some corrective pullback. 91.00 and 90.80 offer initial support, along with the dynamic support of 20 days moving average, while 90.50-60 zone is expected to contain an ideally reversal above this level, would keep the immediate bull tone in play for a fresh attack at 91.47. Key support is psychological level at 90.00, below which would turn the near-term outlook bearish. On the wider picture, we can see that the pair remains well supported, as holding above the main short-term bull trend line drawn of 70.67, the record low of dollar Swiss. with break of our previous low at 191.47 to turn the short-term focus higher and expose the key barrier at 93.13, 6th of October peak. From commodities, starting with the gold, is currently at the back foot, actually moving in the consolidative range after peaking at 18.02 and the second attempt higher was stalled at 17.95. The gold comes under pressure as the recent negative developments in the Eurozone are pulling investors from the riskier assets, but however it remains well bid while holding above 17.35, the low of 10th of October. Current range is seen consolidative ahead of fresh push higher as the daily outlook remains firmly bullish and looking for extension above 18, a clear break above 1800 to open 1828 and 1844 next. On the downside, the 55 days moving average and the low of 10th of November at 1735 zone are offering good support as the 20 days, raising 20 days moving average on daily chart already crossing above 90 days, now approaching 55 days simple moving average, cross above which would give additional bullish signal to the yellow metal. The crude oil is currently in corrective consolidative mode with the 97.50 our initial and 97.50.30 initial and strong support, as well as for our 20 days moving average holding the dips for now. The overall outlook remains positive and looking for a further extension and possible retest of 100 per barrel level, which is our initial target as the pair reached 99.54 fresh high yesterday. Clearance of 100 opens which is opens 100.60, the previous high of 26th of July, and opens way for a further extension higher. Current barrier at 99.50, which is previous high, and 61.2% Fibonacci retracement of the broader downtrend from 114.80 down to 74.94 is capping the upside for now, with clearance here to open wave towards 100 and 160 next.